Let's get across the market open now. Scott Phillips joining us from The Motley Fool. Scott, happy Friday to you. Let's start stateside because a lot of focus there clearly on what the Fed's going to do next. There's a battle emerging within the Fed, in fact, those two camps there. What are you seeing at the moment? Because there's a risk, obviously, inflation is going to continue to rise, but at the same time, concern over jobs.
Yeah, mate, and that's, I mean, look, stagflation, anybody, that's the real risk right now, I think, in the American economy. Good news overnight, the economy is growing pretty quickly in the US, so that's pretty positive. Whether it's enough and whether the impacts of that end up being that inflation you mentioned, the jobs numbers have been soft. Jerome Powell had said at the last meeting, jobs are not growing fast enough to keep the unemployment rate down. So they've got both those issues happening at the same time. Devilishly difficult, mate. We know that on one hand, Trump's nominee wants rates cut by 0.5% last meeting, and Trump has said he wants 3 percentage points cut off, which of course is madness, but that's Donald Trump for you. He's planning on that one. The real challenge, I think, for them, as you say, is how do you manage the combination of inflation and jobs? Throw economic growth on top of that. Again, we've talked about tariffs so many times. The thing is, the tariffs really haven't hit in any meaningful way yet. So whatever happens over the next 6 months are going to be the story of the tariffs. If they're really lucky, it's a non-event. If they're unlucky, inflation jumps. If that happens and there are job issues, they're going to have to either choose one or the other or just happy to accept both. So the Fed's in a really devilishly difficult position. I think cutting rates would be any more to be crazy right now. I mean, it's their call, but given where inflation is, we'll talk about our inflation, I imagine, in a second, but that global inflation story is well and truly still very much live, despite hopes to the contrary 2, 3, 4 months ago. So they got a tough road to hoe over the next 6 months. I mean, we're all hoping it does well, right? Because whatever happens in the US is going to have ripple effects here in Australia and right around the world. But hopefully they can muddle through this one okay.
Yeah, despite those concerns, Scott, we are seeing those risk assets continue to climb. Taking a look at the equity market, record after record. Does that make you nervous?
A little. I've said it before, mate. I'm always an optimist, but I'm always happiest being an optimist when everyone else is pessimistic, right? Because that means I'm getting a bargain. When everyone else is excited, when, as you say, risk assets are like gold. I mean, it does feel like a flight out of the bond market into everything else. Growth assets, risk assets, call it what you want. Purchasing power protection is pretty much what people are looking for. And so that's the trade. That's why gold and shares are up. We don't know for sure, of course, but it's the best guess. That's why both gold and shares are up at the same time. The alternative, there is no alternative, but there's a couple of alternatives, but being in cash isn't one. And increasingly, the bond market saying, a bit nervous about that one. We've even seen Australian superannuation funds get out of that sort of stuff to some degree, not entirely, but just wind back their exposure. So that flow of money, unsurprisingly, going in those directions. The US market's a funny one, mate. For years, we said the Australian market's super concentrated, banks and miners. Overseas gives you some exposure, some diversification. That's still true, but the US market itself so incredibly heavily concentrated around tech at the moment, and the valuations there are pretty pricey. I don't think they're necessarily out of the realm of possibility. I don't think we've ever had a market where the biggest companies are still growing at double-digit rates. So you've got this really weird kind of idea of trying to get your head around. The P's look high for the market as a whole, but the days when GM and Mobil and Exxon, and GE and those sort of companies were the biggest in town, they weren't going to grow at those sort of rates. So yeah, the P should have been lower. I'm far from convinced the market is overvalued, because I do think the growth these guys are getting, I'll put Nvidia aside, I wouldn't buy those shares, but the growth the other guys are getting, the Googles, I own shares, the Apples, the Facebooks, the whatevers, their growth is pretty good. So I don't think we want to necessarily rule out that the US market is okay. I don't think it's cheap, but I don't think it's particularly overvalued, not necessarily overvalued, if these big behemoths, these multi-billion dollar companies can continue to grow at the rates they have in the past.
Taking a look at our local market, those gains much more muted. It's fairly quiet at the moment too. What are you looking at?
It's fascinating, mate. So I had lots of people say, what's going on with the Australian market? Why not the same as the US market? And it kind of goes back to what I just described. The banks are muddling through at best. That's why we've seen 3 of the big 4 banks announce job cuts in the last 2 weeks. ANZ famously 4,500, NAB 410, Westpac 200 tellers. They're doing it specifically because they're not getting growth. Now, if the biggest sector in the economy can't grow meaningfully, or the biggest sector of the ASX, I should say, can't grow meaningfully, what else can happen but the ASX lags the US? And that's exactly what we're seeing. So I've got to say, I hate the phrase stock pickers market, mate, because it kind of always is and it never is. You can buy ETFs and do perfectly fine, but also picking stocks, if you can beat the market, you want to do that all the time. So it's always a chance to pick stocks. But when the markets are high like they are now, it is increasingly, if not a stock pickers market only, The gains are going to come from those who can look at the market and go, what's expensive, what's cheap, what do we buy, what do we sell? If you want to outperform the market meaningfully, and you have to if the market's already meaningfully fully valued. When the market crashes 38% in early 2020, you buy anything, or almost anything, a diversified lot of anything, and do very well from there because the market's going to come up, lift all boats, all that kind of good stuff. So you didn't have to pick stocks to have a really nice return from that point. From this point, I dare say the successful stock pickers should, if they're good, have a bigger gap, a bigger delta. Use the horrible jargon. Should be able to put a bigger, gap on the market itself if the market is fully valued. I think it probably is, and that does come down to resources. It comes down to miners. It comes down to banks. Where the finance industry goes, where the resource industry goes the ASX. We've known that for years. So what am I looking at? I'm looking at opportunities outside that, mate. I'm looking for companies that are worth buying. Fair to say, harder to find value. I'm not a capital V value investor, but no one wants to overpay. So harder to find stuff that looks particularly inexpensive when the market itself is riding high.
Scott, focus on some of the retailers this week in Myer and Premier Investments. Of course, they've got that tie-up too. Yeah. What did you make that? Gee whiz. I mean, Myer, those shares were absolutely hammered.
And justifiably too. Myer is in a world of hurt, Andrew. An absolute world of hurt. The corporate entity might be okay. The Myer department stores are in a massive world of hurt. They grew like-for-like sales 0.5%, and profit fell 30%. Why? Because you can only grow your sales anemically, and your costs, staff, insurance, electricity, rent, go up by more than your sales growth. You're going to have profit crunches. And if you're a retailer with low net margins to start with, the operating leverage, which is wonderful when you grow, turns against you really quickly if you can't grow much or if your sales decline. So they have got all sorts of trouble. They have for years. This is not a new story. Hope does spring eternal. Every now and again, every couple of years, they have a good half, and people think maybe Myer's finally found its mojo. I don't think it can. I really, really don't think Myer is a business that is going to survive the department store business as it currently exists. The Myer Group could be okay. I think Myer's online business is going to be fine. I think the Just Jeans, JJ's, the stuff that Premier managed to flick off to Myer, one of those things where it improved both businesses. Premier got rid of its lower quality assets, so relative to Smiggle and Peter Alexander, the stuff they flogged off was lower quality. Myer got to buy higher quality than its current assets, i.e. the department stores. So it is a really rare case of both companies winning. Can Myer make those things work? I don't know. Solly Lou struggled to make JJ's Just Jeans work meaningfully for any length of time. It was always a case of the other two, the Peter Alexander and Smiggle brands, really, creating a massive growth engine. The others kind of just got dragged along with it. So I don't know. I wouldn't want to be a Myer shareholder, frankly. I'm not saying they can't make it work, mate. Anything can happen. They can make a way to make those retail stores successful. Maybe the combination of the brands, maybe the Myer loyalty announcement they made about the Velocity program they're joining. Maybe those things work for them. Maybe it comes to something. Just a tough business. If I was in charge of Myer, mate, I'd close down every department store other than the CBD stores, double down on your online sales, and try and effectively, cut costs, try and shrink down to some sort of stability and quality, and grow from there. They're not going to do that. It's too hard. They just can't face it. They can't bring themselves to do it. But if the sales are only growing at 0.5% corporately, including the online sales, which were up really significantly, by definition, that means department store sales were falling, and those regional department stores in particular, if you got falling sales, you're in a world of hurt.
Just very quickly, Premier, what did you make of that? In particular, the focus there on Smiggle, some issues emerging.
Yeah, and man, I'll tell you what. So sales are down 10.7%. I mean, it was a real surprise. I've got to say, they've always been. Smiggle's a funny business, right? Tweens stationery. It's a really specific market. They've done a great job making it work. I've got to say, I think they've obviously just had a bit of an air swing. I suspect, it's not like people all of a sudden don't like tween stationery. The tweens themselves love this stuff. I suspect they got the product range wrong. I'm no tween expert, mate. I'm no fashion expert. But if your sales fall $1.09 between last year and this year, it tells you that something dramatically has gone wrong. I suspect the product range is wrong. I think they probably just got the offering not right in terms of what the kids actually want these days. Maybe there's something structural there, by the way, too. Maybe there's fewer pencil cases and staplers and sticky tape holders being sold, but I don't know that's likely. I think that's probably just messed up the marketing and the range, and that's going to happen in a fashion-based business. It's not truly fashion capital left like clothes, but it's not miles away from that, right? Give the kids what they want.
Yep. That's
an important one. And then, of course, the leadership stuff. I mean, Solly Lou was brutal when he came out yesterday. Basically, previous management, there was bribery, there was gambling, there was drinking. I mean, he really let him have it with both barrels. Whether that's a smoke screen, whether that's genuinely a problem, whether he can fix it, having, I think, all of those executives have left, or most of them have anyway. new start. Maybe that's one of those reset kind of halves. But yeah, for what was, as I've already said, a shining light for that business, really, really disappointing data for Premier.